Welcome to the drawing board. In a new paper, Federal Reserve Bank of Cleveland researcher Filippo Occhino explains how something called debt overhang may be impeding our economic recovery. Now, you've likely never heard of debt overhang, but the concept is pretty simple once you break it down. And to do that, we need to take a look more generally at the problems that can arise when a company has too much debt on its balance sheet. Now, debt, of course, is money that you owe. So to use an example, if you take out a loan for a car or a house or to put your kids through college, then you have debt. You owe the lender the money you borrowed plus interest you'll pay over the duration of that loan. Everyone's familiar with that. It's also not hard to imagine how having too much debt can be a problem. What happens? Well, first, if you've got a lot of outstanding loans and you're paying a lot of interest on those loans, that's money that's not going to be spent on other things. You may want to put some money in a mutual fund, but sorry, all your cash is going to paying off your debt. So high debt levels rob you of spending or investing power. Second, having high debt makes you riskier in the eyes of lenders. If you want to borrow more money for another purchase or investment, say a boat, the bank you're borrowing from may think, wow, it's possible this guy's going to go under with all that debt. I don't think I want to make that loan, or if I do, I'm going to charge a higher interest rate to protect myself in case this guy goes under and can't pay me back. Companies face the same problems when they carry too much debt. Their interest payments rob them of spending and investing power. A company that wants to build a new factory, for instance, may not be able to if it's paying too much interest on their loans. The company might also want to borrow to build that factory, but its huge debt makes it riskier in the eyes of lenders, who might not loan the money, or who might charge rates that the company can't afford or just doesn't want to pay. That's how debt generally hampers business investment. But debt overhang is slightly different. Debt overhang is when a company's debt is so large that the company risks default. And right now, that's happening more than it ever has in our nation's history. We're seeing historically high levels of debt overhang in the market. So what's that doing exactly? Well, it may be dissuading companies and their investors from taking on projects that, if not for the debt overhang, would be profitable for investors. Here's how the debt overhang effect plays out. Say there's this company, and its assets, anything of value it owns or controls, are worth $1,000. And let's say its liabilities, what it owes or is obliged to pay, are worth $900. That would mean the equity in the company would be $100. The total value of the company's assets exceeds the total value of all it owes by $100. Now, let's suppose there's a project the company's eyeing that looks like it will cost about $100 to fund and is expected to pay out $200 once the project is complete. In this situation, if the company can't afford to fund the project on its own, it would look for an investor to come along and put the $100 in. If the company makes its $200, its assets rise from $1,000 to $1,200. Liabilities are still $900, which means equity in the company after the investment goes up from $100 to $300. Not hard to see why an investor would choose to invest, and not hard to see why the company would chase that investment. It's good for everyone involved. Now let's say, instead of the company having assets of $1,000, assets are only $750. Maybe the value of assets has fallen due to this economic crisis, and that has happened. Many businesses have seen the value of their buildings, for instance, drop in value compared to what they were worth a few years ago. Now you've got a situation where your assets at $750 are lower than your liabilities, which are still $900. Which means you have a negative equity in the company of $150. In other words, the company owes $150 more than it's worth. So that same investor comes across this company with the same project in mind, a $100 investment that will yield $200 in equity in the company. Does the investor make the deal in this situation? Probably not, and here's why. When the project's complete and it makes its $200, it pushes the total assets of the company to $950. Liabilities, remember, are still $900, so equity in the company rises from negative $150 to positive $50. Good for the company, but not so good for the investor. Remember, The cost to invest was $100. So the investor would be looking at a $100 investment that would result in taking the company equity from negative $150 to positive $50. So the investor has spent $100 to raise equity in the company to $50, which is a loss of $50 on the investment for the investor, even though it built $100 in equity in the company. This is the problem debt overhang presents. Deals that might be good for the company are unable to attract investors because any profits they make are eaten up by the high levels of debt the company is carrying. And here's another unintended consequence of debt overhang. It may also be enticing companies to make riskier investments, since only investments with a large upside potential, which by nature carry more risk, would build enough equity in the company to make the investment pay off for investors. Given the pressures that debt overhang puts on investment and business decisions, and given that we're seeing the highest levels of debt overhang in history because in the long run-up to the crisis, businesses were borrowing big on assets that then dropped like a rock after the crisis hit, Occhino believes it's likely that debt overhang is exerting a significant drag on investment and growth, and that combined, this is likely to be hampering economic recovery. He also cites that in some situations, one possible way to work around the debt overhang problem and its likely drag on the economy is for lenders to forgive a portion of a company's debt. If a company is so in debt that it risks default, the value of its debt is likely to fall. So it would put companies in the situation we described in our second example, where an investment in the company would actually cause investors to lose money. If lenders were to forgive some of that debt, the company would be in the situation described in our first example, where an investment in the company is beneficial for both the company and the investor. Now, we have to emphasize that some measure of debt forgiveness is only doable under certain circumstances and represents only a partial potential solution. For a more detailed analysis of the debt overhang problem and ways that it might be addressed, you can read Occhino's paper on the Federal Reserve Bank of Cleveland's website. Something to think about until the next time on the drawing board.